Right, we are live. So today's stream
Everybody.
on Sunday, November 3rd, we are somewhat in the middle of earnings season. The first couple of weeks have just been pretty intense with big giant companies. But, hey, let's catch our breath because we got more to go. More to go. We're going to be seeing a lot of companies announce this coming week and a lot of I'm going to call mid cap stocks as well as small cap stocks. So we're going to have a high volume of companies announcing this week. And we have a massive election. And then the Fed, they have a meeting on Thursday, and they're going to tell us if they're going to reduce rates. It's expected they're going to reduce rates by about 25 basis points. So we'll see if that happens. So it's another big week following a big giant week. So today is this treat. Scott's joining me. We're going to do the collaboration. So you get two different viewpoints, maybe on a stock, and two viewpoints on, where the market's at and so forth. So Scott, how are you?
I'm good. So election year. This is the way I remember it. Every leap year is an election year. Every we vote. So it's a leap year. This February had a 29th day, and we vote for a new president. They actually won't take office until 2025, but that's just how I always remember it. If it's a leap year, it's when we vote for a president.
I never thought of it that way. Keep going.
Yeah. And I was born on a leap year too. I mean, I was born in October, not on the 29th, February 29th, but that's how I kind of keep things in my head. I need these patterns as I get older to remember things. Because so it's craziness. It's always craziness, really. I mean, I know, but the super micro situation is just wild. But the thing is, if you really, if you had the opportunity to really dig into a company's financials and understand how they make decisions, there's a lot of fraud going out there. Like a lot of companies commit fraud. The thing is, it's so minor. I mean, we all commit fraud. Like when we do our taxes, I mean, you have to do everything. You can't overstate your earnings. Things obvious fraud, but I mean, sometimes you slip things in, which is kind of like it's kind of a personal expense, but it's also a business expense. But you just can't be egregious. And Supermicro, I mean, it's so egregious that the accounting firm quit. They're like, we don't want millions of dollars paid. We don't want to receive millions of dollars from you for doing our job. We'd rather just quit. Because it's a big company, Supermicro. So it's just it's really wild. And I feel bad for the people, because I know a lot of people got into the stock thinking, okay, I missed NVIDIA, but Supermicro is doing just as well as NVIDIA in terms of how much the stock went up. And 60 billion of value has been wiped out the past week. And that's most of the small guy's portfolio. Like if you had a $50,000 portfolio, it might be 40,000 now because of Supermicro. Yeah.
If you look at the chart on Supermicro, that's not looking too good. It looks like a thunderbolt.
Yeah, it's pretty much all this. I mean, it was going down. Like in March 2024 was its peak. They did a 10-for-1 split. So in March 2024, it was actually over $1,000 a share. I mean, if you look at the chart now, it's 120 because it's stock split adjusted. But so it was 120 at its peak, and now it's 26. But it was coming down. But I mean, it wasn't coming down because of fraud. Before this month, it was just coming down because it was overvalued. But
yeah, I suspected so. I get the story on Supermicro, which was hey, if you missed on Nvidia, here's kind of the poor man's Nvidia. But that was really risky because Nvidia is very different than Supermicro. Nvidia holds patents on the best accelerated computing technology on earth, the best GPUs on earth. So they can charge a premium, and they have a huge barrier of entry, which is that patent. Nobody can just copy their technology. But Supermicro is a hardware company, and they try to make their hardware a little different, which is, hey, we assemble this hardware to be better performing. And I'm sure there is some, I would say, incremental performance improvement through, Supermicro. But very quickly, Dell and Hewlett Packard Enterprise can catch up, and whomever else does hardware. So the hardware business is not the semiconductor business. They're very, very different animals. And I, think I shorted Supermicro. I made 52% on the stock, I think, over 2 months.
Amazing. Amazing.
And it was luck, part luck, but it was part. I look at these charts and go, this is not normal, and this isn't going to end well. This is going to end painful for investors. And it happened. It's cratering. And I don't know if, so here's a question. It's probably a guess, and I'll guess after you. Do you think Supermicro is going to make it out of this? Or do you think they're going to be basically non-existent?
I think they will. Obviously, I don't know. Like it's hard to know fraud until you're on the inside. It's kind of like with because it could be hidden pretty well. So sometimes it's hard to really know what's going on. But it's kind of like Enron, a second Enron. So, but I don't know if it's that bad, the fraud. It's really hard to tell. I don't think it is. I don't think it's that extreme. So I think this is just my guess. I think they'll be kind of like, it probably will go down more, but I don't think it'll ever get up to those levels ever again. And I think it'll be cratering for a number of years. But
so
I don't think
the company will continue to exist, but they're not going to be as relevant as they are now. This is your assessment.
Yeah, I think they'll be kind of flat for a long time. And because there's too many eyes on them, too many people. Because if you're an NVIDIA, a really respected company, or so many companies deal with Supermicro, probably a lot of those companies probably want to stay away from them. And even if Supermicro has they provide amazing servers or amazing technology, even if it's great, like it's kind of like sometimes when there's a kid in school that is always getting in trouble. Sometimes you just want to stay away and not be associated. So I think they're going to lose a lot of that, like relationships that way.
Yeah, I think so. My guess is they're done. They're.
You think they're done? Yeah.
Yeah, and you think about, okay, so Nvidia's and the rest of the technology companies. Right now they're allocating, right? They're allocating inventory and saying, okay, so-and-so is going to get this inventory. And right now I have to think that Nvidia is like, okay, do not ship anything to Supermicro. Everything that's shipped to Supermicro is paid in advance. And we're not quite sure that, where they're going to be in 3 months. Customers. You think customers are like putting in orders with Supermicro and saying, "Oh yeah, I'd like the extended warranty." No.
Right.
It's like, "Oh yeah, let me sign up for a 3-year service plan with you." No, that's not going to happen. But and I'm sure the Dell reps and Hewlett Packard Enterprise and whomever else sells, hardware is knocking on doors saying, "Hey, I know you had a project that you thought you were going to use Supermicro on, but let me show you what we can do." And we're going to be around. We're Dell. We're Hewlett Packard Enterprise. So it's a bad situation, really bad. You have to. I mean, a public accounting company does not walk away. I don't know that I've ever seen this. Have you ever seen this?
I've never seen it before.
Yeah. Usually it's even when a company changes firms, like, hey, we're going to go from Ernst and Young to Deloitte, they will notify the market, hey, we're going to make this switch because we feel that Deloitte handles Asia better and we are growing big in Asia. We've had a great run with Ernst, but we're going to move on. And they give everybody plenty of notice, and then the new accounting firm has time to kind of ramp up, and then the first audit is successful. In this case here, I mean, they are untouchable by the other firms. The other firms, I mean, they'd have to charge them so much money to sift through everything with a fine-tooth comb just to make sure if they provide an opinion on their financials, it's going to be like, we checked everything out. There's no stone that was not unturned that's material. And the expense of that's going to be massive. It's also going to be a big distraction. The company's going to be really, really distracted. So again, it's a hardware company. It's not like, hey, Supermicro owns this patent that everybody has to buy. No, that's not the case. They make servers. They make good servers. They make really good accelerated computing gear, but so do others. They can be easily replaced, and we're going to see how quickly they're replaced now.
Yeah, they were, and a company has to actually legally let us know if they change CPA firms in the 8K filing. And a lot of people don't even read the 8K filings, but a company must, for major events, like if they fired the CFO or fired the CEO or changed accounting firms, or they went from LIFO to FIFO, major things that would affect the business, they have to mention the 8K. Now, whether you read the 8K or not is a different story. I mean, they're probably not going to this is blown up, so obviously they have to talk about it now. But if it's a major event that's not blown up, they'll probably just mention it in an 8K and never mention it again, and hope most people don't realize it. But I'm really excited because I did a live stream yesterday. I made a video also a couple of days ago, but I'm really, because they didn't mention at all on their website about CNY firing them. So I think they did say on Tuesday they're going to announce. So I'm really interested in what they're going to say. And they're going to release earnings, their annual earnings, because their fiscal year ends 8/31, I believe.
Yeah. And I don't think they're going to take questions after they announce. I think they're going to have some prepared remarks and then say, and that's all we have to say, because there's a piece to this, right, where if Ernst & Young is like, hey, we're uncomfortable with this, we're out. Okay, it was substantial. Now, like it was the case in Enron or other places, if there was some fraud, some officers are going to jail. Okay, so having said that, the officers are not going to speak very often on record, because if they were to be asked a question by the the people that ask questions, usually the big hedge funds or big funds will ask questions, and they get asked a question, they answer it, and then they come back and what they had said there was not correct. They're personally liable. So the officers are going to be, probably their attorneys are telling them, do not take any questions. Do not speak anymore in public.
Yeah, it's a real situation. It's not just getting fined and paying a penalty. It's jail time. So it's a pretty big deal. And I'd be real nervous. It's usually hard. If you're a small business, you can do things kind of shady, and probably no one's going to realize it because no one's looking at your business. Like, I don't recommend it, but if you do things shady, you probably will not get noticed. Obviously, if you get audited by IRS, you're screwed, of course. But when you're a public company, you kind of have to avoid shadiness because it's gonna get found.
Yeah.
Whether you get prosecuted or not, like most people don't get prosecuted. Most executives who are part of the shadiness and illegal practices just end up actually finding another job at another company and nothing ever happens to them. But once in a while, if you're like an Enron or there's a few other companies,
Yeah, I
might go to
remember
jail.
that big communications company was called MCI. Remember them? They imploded as well. And they came out with Sarbanes-Oxley like after Enron
All right,
happened around 2001, and then Sarbanes-Oxley came out. One of the key requirements there is officers of a publicly traded company have to sign that, hey, these financials are, I know these numbers and I stand behind these numbers, right? And I'm personally liable. That's comes with the territory. And the reason they want that is that, you know, prior to Sarbanes-Oxley, I think some of the officers were kind of playing dumb, like, oh, I didn't know that. Like, what do you mean we were overstating revenue? It's the accountant's fault. I don't know accounting. So instead, they're like, all right, so we want officers to sign these and say, you own these numbers. You cannot use a defense of kind of, I didn't know, or it wasn't my job. No, these are your numbers. If you need to ask questions, you need to ask before you sign. So we'll see. That's I'm sure a big piece that officers at Supermicro have to deal with.
Yeah. Because we probably like if something is illegally, is illegal like on our taxes, we could always say, oh, the accountant did it. I'm not a CPA. Even if you were the one who kind of like told the CPA all the information and said, no, I made this much money when you really made a different amount. Because generally people won't go to jail, like regular people like me and you won't go to jail if our taxes are incorrect. We would just get hit with a penalty, like maybe a fine by the IRS. But yeah, with SOX, they kind of like, they can't hide behind, they have to take accountability.
There was a company called, I think it was called Health South, and in that case there, all the CFOs, because there was like a string of CFOs, and all the CFOs basically pleaded guilty and made a deal with the feds, and basically said, "Hey, we'll tell you everything we know." So, like 5 CFOs all said, "Hey, the CEO forced us to overstate revenue and really, in essence, manufacture financials." And the CEO, excuse me, successfully used the defense of, wasn't my job. It's the CFOs. They're the ones that did it. And they'd have to explain it to you because I have no idea what they were doing. And but now over the long haul, he lost everything. And he ended up doing some prison time because they found him guilty of some stuff. But the direct, that he was guilty of the fraud was not the case. Since then, we have Sarbanes-Oxley, where it removes that defense, which is, even if you don't know, you are signing here saying that it's your responsibility. It's your responsibility to ask for an explanation, and you cannot use this as a defense going forward. So interesting how this plays out. I think it's going to take a year, maybe 2 years for this thing to kind of go through its ugly path. If this thing comes back and becomes relevant, this will be the comeback story of comeback stories. I can't see it coming back.
Yeah. That, and and the thing is, if the SEC and IRS, all those parties, they can't ignore it. They have to do as much as they can to make an example, because then if they don't like either fine them or do something, assuming they did something wrong, then it leaves the door open for other companies to do illegal activities.
So different perspective on this. 2 years ago, this was a $5 stock, and as you said, it got over $1,000 stock price in less than 2 years. So just kind of dreaming out loud, I guess, is, I mean, how do you treat these high flying winners? I've never stayed in a big winner that long. I don't know if you have any experiences that resemble this.
No, I mean, if you pick like I try to invest in really, really good companies, so I don't have to worry about timing and when to sell. I just keep holding. And even if it goes down, I keep holding, or I may buy more actually. And everything goes down during crashes like the COVID crash, the .com crash, all those crashes, everything goes down. But if you hold really good stocks, you don't have to worry because you know it's going to come back. That's the thing. Like with a company like this, I mean, it seemed like a really good company. I mean, it really didn't do anything. I think they IPO'd in 2007. It looks like. Mm-hmm. So from 2007 to 2021, it pretty much was flat. So 14 years, it didn't go up much. And then it just hit like a rocket ship from 2021 to 2024 and went to the moon. So I would have sold a long time before it went to its peak.
I would have sold at $50.
Yeah, I mean, I wouldn't have waited, and then I would have been pissed. I would have felt like an idiot.
Oh man, it went up to 1,000.
Now I would feel vindicated. So that's you're never going to be happy. Yeah.
I know. And, you know, when we look at some of these, like, I'm going to call them like, you know, how like a star, when it gets really old, it basically collapses on itself. Supernova.
Yeah.
It's kind of like Cisco. This is a real company. Obviously, they still produce products. They're bigger than they were when they were building out the internet. This was a real company, and they just took off. They went from, you know, and this is all, you know, average because they did so many splits, but they just went sky high, and they were still a real business. This was the leader in networking equipment, still growing year after year, but it kind of collapsed on its own weight, and then it went way down. If you look at it, just collapsed after the .com bubble burst. But this was a real business. This isn't like, hey, they went away. No, they kept getting bigger and bigger and bigger and bigger. But the stock prices never recovered. Now, this is a sound business that had the best technology in networking, and it's still a big, big company. This is not Super Microcomputer. Super Microcomputer is very replaceable. Cisco is not very replaceable. These guys were setting up the biggest networks on earth, setting them up for governments, setting them up they were, you know, the biggest player in networking with the best technology. And it's taken them 24 years to get back to 60% of their about 60% of their previous high. It kind of shows you the painful path that Supermicro has ahead of itself.
Yeah, a lot of companies, you see kind of this pattern. Dell is similar, where it really, really peaked in 2000. Intel really peaked in 2002. And they just never got back to those levels ever again. And they're not like going out of business. They're still generating lots of revenue and profits. But if you did buy Cisco, if you owned it since the 90s, you're getting you own a company, so you're getting that dividend. So that's,
you're still okay. I mean, if you were like
you benefit, because if you got it like under $10, your yield is they're paying a 3% yield if you bought a stock today. But if you got a $10, you're getting like a 50% yield. So, I wouldn't. You're not doing that bad. Of course, if you bought it north of 40 or 50, yeah, you're never going to get your money back probably.
And that's why you diversify. That if you get caught up on one that's really going to be a loser, hopefully the rest of your stocks overall are doing great and they get your portfolio to perform well. All right. So I think you wanted to talk about MPW.
Well, I just thought it was interesting because I kind of learned something new, like, because maybe I should share. It's not that straightforward. Is it sharing?
Not yet.
Okay.
You have to add it to the stage.
No, I was in a different screen. All right.
There you are. Oh, there we go.
So this was getting a lot of people looking at Medical Properties Trust because they were paying a really, really high dividend. It's still paying a high dividend. It's 7% now. So it's a REIT, and they have medical care facilities like emergency rooms and aftercare facilities. So they have like 435 properties, 53 operators. But one of their biggest operator is Steward. Steward filed bankruptcy this year. So Steward is 17% of their total assets. So so the stock is down like 85% in 2 years because Steward was unable to pay all their the monthly rent payments or lease payments to this REIT. So this REIT was getting a lot less cash flow. And so the revenue for the most recent quarter, they haven't released their third quarter. I think November 7th they're releasing their. So I guess this Thursday coming up. So the revenue for the second quarter of 2024 was $266 million. It's down from $337 million. But they had a big net loss, a loss of $325 million for the quarter. And it looks like they did, revenue, it's lower, but it's not terrible. And expenses, $246 million. So it looks like they did okay for the quarter. But they these huge write-downs, $401 million loss from equity interests. And you could find it here from Steward Healthcare. That was pretty much entirely from Steward Healthcare. They took a $410 million loss. So they wrote down that entire investment as if they're not going to collect anything from that company again.
Yeah, I mean, I've followed MPW for some time, and if you look at the income statement, a big part of what was an expense was depreciation, which we know is not a cash item. It's
Yeah.
you already own the property. You're just depreciating it. Having said that, they do still have funds from operations and they have cash flow. It's just taking forever for Stewart to get through their bankruptcy, and it's just really dragged investors through a really, really arduous, declining process. My intuition leads me to think that at some point this thing is going to go up. I don't think it's going to go bankrupt, but
No.
it'll go up at some point. But I still think, they got themselves into this mess. And, and imagine this. What if a second tenant goes bankrupt? They'll be
Then they might go
really
bankrupt.
bad shape.
Then they might have to go to business.
Yeah.
So the thing with REITs, it's kind of, they don't really have many employees at a REIT. It's similar to like a management company, and you probably understand this, Victor, because it's they just own real estate, and the businesses who operate in the real estate they own, in this case, it's medical facilities.
Mm-hmm.
They have many employees and many expenses, but the expenses of the businesses that operate is not the REIT's expenses. Like if you rented out if you had a commercial space and you rented out the space to a business, that business would have expenses and income, but that's nothing to do with you. You don't have to pay their expenses. They just pay you rent.
Mm-hmm.
So it's pretty low overhead for a REIT. They just have real estate and they lease it out to different businesses. Some REITs lease out to regular businesses, like a Costco might be one of or they might have a whole shopping center. Other REITs lease out to data centers, like a Supermicro might lease one of the spaces. And one thing I've seen before that I was always confused about, and I couldn't I didn't really understand it that well. Now I understand it, and I'm going to try to explain it. I'm not sure, but when you see negative revenue
Mm-hmm.
for a company, how do you explain that? Because how could you have negative revenue? Because it's like if you have a store, right, where you sell like candy, and a customer comes in, buys candy, but instead of them giving you cash, you give them cash.
Well, it would actually be, let's say in the month of September, you sold $100 million of TVs, but in the month of October, $90 million of those TVs were returned, and you didn't sell any net new TVs. So you would have negative revenue in that case, because you have all these refunds, all these returns.
Okay. So I guess that's interesting. But what they did was, in their case, they just they wrote down, like they just like they have these contracts in place with their tenants who are going to pay rent, say a 10-year contract where they lease a space for 10 years and they pay rent based on the terms. So what they did in the fourth quarter of 2023, they just wrote down, they just assumed they weren't going to get any rent payments. So they passed through a loss on Stewart for the rest of their lease payments. So they passed it through in this quarter. Because when what's that?
Yeah, I'm following you.
Because it's kind of like if you know how accounts receivables works, like you sell something to a customer and they don't pay you up front, they'll pay you in the future. So if you have, 100 million of accounts receivables out there to all your different customers, you can't report, you can't put 100 million on the balance sheet. You have to put
your expected collections net of
so you have to pass through
write-offs.
that's the word, evaluation allowance, and it's usually like, depends on how your collection process, but it'll be maybe 2% you expect you're not going to get. So on your balance sheet, you have to report 98 million. That's your accounts receivables. Even though you sold 100 million on credit, you can't put 100 million. You have to put what you actually expect to receive. So it's kind of like this. You can't just put how much rent you're, like if you have 100, if you own an apartment building and you expect to receive, and you have contracts with all your tenants where they're going to pay you, say, $1,000 a month, you're probably not going to receive full rent every single month. You'll receive maybe 95% of your rent over the long term because people default or whatever. So I thought it was just interesting, but you have to kind of know this stuff, and it's kind of confusing. But if you really understand how this stuff works, then you might have been able to identify a stock that was going to crash, and maybe you could have shorted it. Ed, I haven't seen you in a while. MPT has either solid or have a new number of renters for all buildings. Well, I think what you're saying, Ed, yeah. So no. Yeah, most of the tenants they have are leasing the space for the next like 10 plus years. So they're kind of locked into getting paid from their tenants. I think that's what you mean. But that doesn't mean a tenant can't go bankrupt or default. And if that happens, then they'll be unable to pay their payments.
Yeah, we'll see how things play out. They've got to get through this Stewart situation. Just can get, and I guess they're going to get. I mean, how is that going to work? Like, they're going to get possession of the properties back. That's what's hard about this business is, they are occupying your property. So it's not like, hey, I'm going to ask you to leave and then I'm going to have somebody else lease it, because these are hospitals. These are big, operations. So I think it's going to be it's been messy and it's going to take some time. I would say that, if they got themselves into this mess, there was a lot of bad decisions made by management. And I would say that they probably should do a changing of the guard and have some fresh eyes on this, that maybe have an aim to get beyond this and not repeat it. Like, let's not make the same mistakes over again, because we don't want to re-enter this into a situation like this again. That's just going to drag our investors through, hell and back again.
Yeah. I mean, that's the beauty of being in America. Like, when you file Chapter 11, it's kind of like a get out of jail free card. You just don't have to pay your debts anymore. You can just start fresh. So they'll be able to operate. This Stewart will be able to continue operating their business, and they're going to renegotiate the terms with all the companies they owe money to. And then because medical properties trust, they can kick them out at any time. They don't have to keep Stewart, but it's almost impossible to find a replacement, because it's not like you're just renting out like a 2,000 square foot store where any business could go into it. I mean, these are really big facilities. So it's in MPW's best interest to just work with Stewart, and then hopefully Stewart at some point gets back on their feet and is able to pay full rent. But right now they're paying either like 10 cents on a dollar or nothing at all until they get through the bankruptcy, and then they could start paying again.
Yep. All right, perfect. So
yeah,
MPW is just a tough situation. If we can stay in the industry and talk about CVS, I saw that I think they're going to announce soon, and would love to get your thoughts on CVS and what you think is going to happen with CVS. Do you think they're going to bounce back?
Yeah, I definitely think CVS is not going anywhere.
Yeah, if you look at, this stock has really come down, and they were riding high. Like after COVID, the stock was like above $100 per share. Now it's down to 55. The dividend is pretty decent, and their revenues. What's amazing is the revenues keep growing, but the stock just keeps dropping. And let's look at their cash flows. Cash flows. Now, cash flows have been dropping, so the market is responding to that. But for a while, their cash flows were phenomenal, and then cash flows began to go down, and down when the stock price. This one here, it seems like there's just too much there. There's too much value, and this is a pretty stable industry. One of their competitors, Rite Aid, is out. They're bankrupt. They haven't seized all operations, but I know they closed a Rite Aid near my home. I think some stores were closed. So that particular competitor has been weakened and maybe completely out of the market at some point. So then they're going to have Walgreens to contend with, but that's one less competitor. What Rite Aid is kind of out. So we'll see how this stock does, but if they can repair their business, this one could be a really nice rebound story that can reward stockholders.
Yeah. I think it's a good long-term play, but it's going to take a long time because retail it's not going away. But retail is a tough game, and it's getting tougher, especially with like theft and higher prices. Payroll is getting higher. So, so companies like this who have unbelievable revenue, like ridiculous amount of revenue, are not that profitable anymore because just expenses are getting so high, and there's lawsuits, things like that. So they're getting squeezed out of the market. But I think they could ride the ship because the smaller companies are going to get knocked out, go out of business. The real small pharmacy, if there's someone who owns one or two pharmacies in their hometown, they're going to get pushed out. And then even a company like Rite Aid, they could possibly get pushed out. And then the companies that are left are going to take the business.
Yeah, 18 analysts cover CVS, and they think it's discounted, that at some point it's going to begin to rise.
Yeah, it's been discounted, for a long time. And I mean,
revenue is going to keep rising according to forecasts that analysts have. Earnings per share will keep rising. I mean, there's a lot of things that are looking good. If they can execute, there's only one way that it's going to go. I think it'll go up. So it'd be interesting. And I own CVS, just transparency. I got into CVS recently and just see that there is a lot of value there. And they are a retailer. They're a pharmacy, kind of a different type of retail. And, but they're also insurance payer. They bought Aetna, I believe, and then they operate Aetna as an insurance payer.
They have a big insurance arm. Exactly.
They're trying to do on location medical services. So you can go there and, to some of their locations are like urgent care. So you can go there and get seen by a medical professional. And so they're trying to kind of be vertically integrated so they can provide more of the overall treatment to a patient and keep more of that revenue. So far, it hasn't worked well enough to make the stock go up, but we'll see if it works in the future.
Yeah, it's been struggling for a long time. Its peak looks like 2015 was its highest point ever, and it did get in the beginning of 2022. It almost got back to its highest point ever. But now, like it was over 100 in the beginning of 2022.
Wow, look at that. So they had a previous peak. I didn't see that. So they had a previous peak in 2015.
Yeah.
They came down quite a bit.
The thing is, if you pick it up now at 50, let's just say you pick it up 50, even if it goes down to like 20, 30, I know you'd be annoyed. But if it does get back up to the $100 level, and even if it takes 5, 6, 7 years, and say they pay a 5% dividend when it gets up to $100 level, you got it at 50. So your yield is 10%.
Yeah.
Which is a phenomenal yield, because a dividend is kind of like a, guaranteed income. You don't have to question it. Even if the stock goes up or down, you're going to get that dividend, assuming they stay in business, of course. And that's it's kind of more of a dividend play. It's not gonna make, it's not gonna 10 or 20x. I mean, it could double, triple your investment. But I think you get that safe dividend, and so I think that would be very appealing to a lot of people.
Yeah, I agree. Yeah, we'll see how this plays out. We'll see. I mean, the earnings, going into the earnings, right? So let's look at the last couple of quarters. And if we look at the quarterly, so the last in Q2, they announced that they grew at 2.47%. The earnings, they were profitable, profit expanded. So that was good. And free cash flow wasn't all that great. It came down, but it wasn't negative. Yeah. They had a negative free cash flow in Q4 of last year. So I think, they can begin to move up if they have a good earnings. And I continue to see positive revenue growth. So it's like, hey, they're getting more customers, or they're selling more to the customers they already have. That's always a positive. So they got that going for them. They just have to right the ship on the expenses, like you were saying. And if they can generate more cash, more profit, then the stock's going to heal and it's going to start to move up.
Yeah, I think it's a good opportunity. But I'm not investing in it. But I would consider it. And I do see, because it's hard to buy a stock and wait years and years and years. I mean, that happened with me a lot. Like, I bought a stock and then, like, I'm down, or I'm not even up that much. But then after 5, 6, 7 years, things come to fruition. But sometimes it doesn't. Sometimes you just put all that money in and it never goes up, and you sell at a loss. So it's a tough game. You just have to have brass balls, I guess.
Well, if you diversify, again, if you diversify, you don't need all your stocks to hit home runs.
Exactly.
You need several of them to do well. Maybe a couple of them are home runs, and then you're making, 15% a year. You're happy because you're diversified, and you might have one that's a stinker, maybe a couple that are stinkers, and you can either get out or hold on, just leave it there. It doesn't bother you as much when, let's say, you got into one stock, it's up 100%, but another stock's down 30. You're like, okay, well, I'm still up.
Yeah, I get how you have to think about it. I say I put a lot of my money into the S&P 500 or some other indexes, maybe half. And everything else, I'm not going to say it's play money, but everything else, I could maybe be a little more aggressive. And even though I made a lot of money on certain stocks, if I lose money on a stock, I'm still upset. I'm never going to be like, oh, no big deal. I'm not going to jump over a bridge, but I'm like, oh, why did I invest in that? It was so obvious. I shouldn't have invested in it. But that's you just got to learn. As long as you learn and not keep making the same mistakes over and over.
Yeah. Yeah, I'm with you. So let me ask you about Airbnb. I recently looked at Booking because they announced, and Airbnb is going to announce next week. Now, I'm an Airbnb
Yeah,
stockholder. I
I know
continue
that.
to like the company, but Booking has outperformed Airbnb. Booking is on this graph that I'm showing is it's the gold line or the yellow line, and then Airbnb is in the blue line. And for a little while, they're kind of trading around the same range, but at some point, looks like October 21, 2022, um, Booking just started to take off, and it pretty much has a really beautiful chart. Well, Airbnb hasn't done so quite nicely. I continue to like the business, but I'd be curious to get your thoughts on Airbnb. What you think of the company?
I do like the business model. I'm just not I'm not that big of a fan for an investment. I think I don't think the margins are that good. Let me look at
Yeah, their
it seems
margins
like it's kind of like Uber's is I feel like is a similar type of business in terms of like margins and scalability. Like it
Mhm.
makes sense as a business, but as an investment, I just don't think it's all there. And it's
So gross margins are 81% for Airbnb.
like gross margin. Yeah, they're gonna have good probably gross margins, but like cash flow. Let's see, they had 10 billion of revenue, and they had 4 billion of free cash flow. So yeah, maybe it's better than I thought. I always
Yeah,
felt like
I think they're one of the things that I like about them is that they are disruptive. And the reason for it is their model's not, hey, we're going to do hotels better than anybody, or we're going to do, travel sites better than anybody. No, no. We're doing something organically different, which is we're going to have privately owned residences put on our platform, and then travelers can stay in homes or condos or apartments or, dwellings that are privately owned for the most part by people around the world. And it's been just a great growth, right? And as we look at, like, they went from 2.5 billion in 2017, now they're north of 10 billion. The one thing the CEO did warn is, hey, Q2 doesn't look good, but Q3 is going to be really good because we're going to have the Olympics in that number. And the Olympics were in France, in Paris. And Airbnb said they were housing 400,000 travelers for the Paris
wow, yeah.
Olympics. So that's going to be in the Q3 number. And the market kind of forgot. And, if you look at the year to date, the market did not like their last earnings, even though they said, hey, we're telling you that we had a soft quarter, but our Q3 is going to be phenomenal. So the market just sold off. I did buy some shares, and I'm sitting around waiting for this earnings to see if what the CEO said was going to happen is truly going to happen.
Yeah. And when I look at their historical PE, it doesn't look like there's ever a great entry point. It was well over 100 PE for a bit, especially when they IPO'd. When did they IPO?
A couple of years ago. They haven't been around for a whole lot. They IPO'd in
Okay, so
end of 2022.
end of
End of
2020. Right?
2020, excuse me. End of
Yeah.
2020. So three years.
So the end of 2020. Yeah, so we're going on to the next month will be their 4-year anniversary, I guess, from IPOing.
Mm-hmm.
And I guess it doesn't look like there was ever a good entry point. Yeah, now that I'm looking at this, so in in 2022 it was 135 PE. Of course, that's crazy. It did come down. Now it's actually getting a little more attractive. Now they're at 18 PE.
Mm-hmm.
So it's finally sub 20 for the first time. It was always 30 or 40. So I guess these stocks start so high, like they probably IPO'd at like a 50 billion market cap.
Yeah, I did not buy when they IPO'd. I don't like IPOs. I just see too many of them. Even these great companies, the IPO stock drops. I let it kind of, and I want to see like a quarter or two of financials once they've been public to really get a good understanding of the business. So I bought after the IPO, but I've held for about 3 years and I've bought more over time.
Yeah, the lowest point ever was 86 at the end of 2022.
Mm-hmm.
So it never got to a really low, a place where it was a good entry point. Unless you're super bullish and you think the company's going to like grow massively and it'll be a $500 billion stock.
Mm-hmm.
But yeah, so it started out pretty high for an IPO, and doesn't look like it ever came down that much. But it's scalability. There is, it's easy to grow because you can.
They're like Uber, where Uber doesn't own any cars and they don't employ any drivers. It's all like micro entrepreneurs who put their own car in service and they drive that car. It's Airbnb is a similar model, which is they don't own any real estate. They're looking for property owners to put more properties on their site, and they are growing internationally. I think that's where the big opportunity is. I think in the US they could still grow, but I think the US is well covered. But if you look at Latin America, Asia, Europe, other places, I think that's where they can really grow. This big surprise to me is if you look at from their low point for Airbnb was in 2022, right? But since then to now, that's covering 2 years. I mean, the stock is not up a whole lot. Try to get this right. There we go. It's up 58%. I mean, that's pretty good. But I'm surprised because you look at their performance as a company over the last couple of years. The performance has been good, especially like in 22, they were a 40% growth company. Growth did come down to 18. And they keep getting bigger. The law of big numbers comes into the picture. And now they're about a $10.5 billion company. I mean, that's a pretty good sized company. And they're growing at 15%. If they can deliver on their earnings like a 20% or higher growth rate on the quarter, I think good things are going to happen in this stock.
Yeah. 10.5 billion, 86 billion market cap. So price sales around 8. A little rich. But if you do see the growth, I don't like see as much value as an investor. Because like companies that make things like manufacturing companies that like Tesla makes cars, Meta sells ad space, like it pretty much all that, all the revenue they can, a majority of the revenue they can turn into profit. This company, is it like a 50-50 split? Probably not. They probably only take like 20%.
But here's something. So I own two properties that I put on Airbnb. Here's what's also advantageous to Airbnb. If like Christmas is coming, right? And we had these cabins up in the mountains, and travelers would say, "Hey, I want to reserve Christmas." And the number one holiday that was always reserved was Christmas Eve, New Year's Eve. New Year's Eve was the most expensive night. And literally you would get a reservation a year in advance. Okay. And they pay Airbnb, but Airbnb doesn't pay the homeowner until the day
Right.
comes when that traveler stays at the property. So for 1 year, Airbnb sits on that cash.
That's nice.
Yeah. And
What's their cut? Is it like something like 20%
it's,
or
yeah,
30%?
call it 20%.
So so when revenue comes in,
Mhm.
they get 20%. So
Well, they get
80%.
all the money up in
Right.
advance. And when the traveler arrives to the property, they kick out 80%. And
Yeah.
it's actually higher than that. It's more like, so the way Airbnb does it is they charge a fee to the traveler, they charge a fee to the homeowner, right? So the homeowner
Right.
nets more like 85, 90%. And then the traveler pays like a 10% fee. Collectively, Airbnb just made 20, 25% on that transaction. And
Right.
they provided tangibly, they didn't provide anything, right? They just facilitated the rental, the
Exactly.
reservation. It's like Uber. Uber did not give anybody a ride. They just facilitated. I need a ride. I get on the Uber app. I get a ride. I pay my $30. Uber gets a piece. The driver gets a piece.
Yeah. Yeah. Exactly. And no, it's a good business model. It's scalable. So when you start with the revenue from the beginning, they're giving away 80% of the revenue is, say, going to the homeowner, and Uber is getting 20, or Airbnb is getting 20% of the revenue. So and then Airbnb has their expenses,
Mm-hmm.
and then that revenue gets obviously chopped down, and they maybe half of it maybe turns into profit for you, the investor. Yeah, obviously, if they continue scaling and growing, they can really be a great investment. I just think, I just don't see like most businesses, they start with all the revenue, and then they have their expenses, and then they get whatever left over.
Mm-hmm.
It's just a lot of the revenue is going back to the homeowner, or if it's Uber, going to the driver.
Well, the revenue that's presented on their financials,
Right.
that's
It's just
really only taking their piece, right?
that's just a fee. Yeah.
They're
Yeah.
not showing the 80% that went to the owner.
Yeah. Yeah. But I'm just saying, for regular business, because in the if you're like, their business model, like, they receive the entire payment, and then they give 80% to the homeowner. So where a normal business, they don't have to give like all their money back to like somebody. Like normal
Mhm.
business, they start with the big amount of revenue. That's why I just don't. I don't see, as if you owned a business that did something like Airbnb did, I think that's great. If you kind of had your own little business where you took a fee, I think that's great. But for an investor, I don't see the growth. But I've been
Well,
wrong before.
that's what's gonna make or break the stock price is their growth rate. If they cannot grow, the stock price is not going to go anywhere. It's just going to be. It's a little bit like if you look at eBay, right? Although they've had a very good year, they've never kept up with Amazon, right? Amazon just kept growing their top line and just kept getting more valuable, more powerful.
Yeah, yeah,
eBay didn't. So if you can't grow, your stock price is not going to explode. It's just, maybe it's a good investment, but I was my investing goal with Airbnb was for it to multi-bag, and right now that's not the case.
yeah. I think that's hard to happen, but who knows? Well, I was just thinking of something. I forgot. It's kind of like, if you own a hotel, it's the same kind of concept. When when you own a hotel or a motel, or when you get paid, like when people pay you to like stay overnight at your place, then you take that's your revenue, and then it gets chopped down based off of all the expenses, things like that. But if you were a hotel and then you had off the top, you had to give 80% of your revenue to somebody, you would never make money. So it's all about scalability. It's kind of like CVS too. Like they're not making much money, but they have revenue so high. So even if they can increase margins by just 1%, the stock could go through the roof because the margins are so small to begin with.
Well, we'll see. We'll see what Airbnb has to say. That's one of the earnings that I'm going to watch and study carefully, and we'll see what they announce.
Yeah. What else? I think I'm.
Yeah, so curious
Amazon,
to see. Have we talked about Palantir yet?
Oh no, tomorrow. Actually, I'll be right back.
Sure. So Palantir announces tomorrow. I think it's going to be the biggest name that we see tomorrow. Palantir is 93 going on 94 billion in market cap. It's certainly been a winner for the past year. It's done really well. It's up 183% in 1 year. Wow, that's awesome. And it's got a little bit of a high PE, 247 current year, forward PE 105. So revenue 2.48 billion. So you're paying 45 times revenue for the company. And some analysts think it's a little too expensive. And they think it's on average, analysts think it's priced 33% too high. Yeah, I did see Blade. I did see that. I did see Paycom shoot up last week. Let me take a look at Paycom. I did see it. I didn't review it, so maybe we can take a look at it later. Now, one thing, Palantir, I wanted to get Scott's thoughts before I put my thoughts out there. So,
that was a big. I messed up a lot of Palantir. I sold it, and then,
oh no,
like a couple of years ago, and I could have had a great return. Live and learn.
Yeah, this one here, I'd be curious to see where you sit with Palantir. I was just kind of covering. It's selling for I would say about 40 times revenue, and PE is really high, 247 for
40 times revenue. That's crazy.
Yeah, and then PE is 100 for forward PE is 105. Forward PE current year 247. Analysts think it's priced a little too expensive. It's priced 33.56 too high. 13 analysts cover the stock.
That's crazy. That's really rich. That's way too rich.
So having said that, and you think about this stock, right? So you look at this valuation, you're like, man, this must be a super high growth stock. 21%. To me, that's underwhelming. It's like 21% and you're 2.5 billion. We were just criticizing Airbnb I was criticizing them. You're only growing 16%. You got to do better, but they're at 10.5 billion. This is 2.5. You should be growing at 50 to 100% if you're going to be valued at 247 PE. Their gross profit, let's see what their gross profit looks like. Gross margins 81%, very good. It's a technology company, software company. But this one here just what are your thoughts? You think
I have a kind of the same. Well, I did buy it at one point because of because somebody was involved. The guy who was involved in Facebook early on.
Sean Parker.
No.
Uh,
He's really well-known investor. He
yeah,
was in.
it's the. I think he's of Indian descent, correct?
No, he's a regular Peter
Okay.
Thiel.
Peter Thiel. Okay. No, but Peter Thiel, was he a Facebook guy? I thought he was a PayPal guy.
No, Peter Thiel just was an early investor in Facebook.
Okay.
He was one of the early investors, but he started PayPal. Him and Musk started PayPal. He actually kicked Musk out of the business so he can be CEO. Did people know Musk started a company called X.com in the late 90s?
Mm-hmm.
No, not X.com. Xfinity.
Yeah. Then they merged with Peter Thiel's company.
Yeah. So X was a company well before Twitter turned to X. That's why he chose X. A little history. So I got involved because Peter Thiel was involved, and I thought what he touches turns to gold. He ended up, I think, leaving the business, sold his part, or something. I read that he's not as involved as he was. Well, according to Simply Wall Street, he still owns 4.5% of the stock. I don't really like Palantir. I just think it's too. I kind of use Buffett's analogy where if you can't really understand the business, don't invest in it. So I don't really totally understand how they make money. I kind of do, but it doesn't make so much sense. Like, it's not like, driving a Tesla. I get it, how Tesla makes money, because I drove cars before. But yeah, I just think I have a hard time grasping exactly what they do. But I missed out on a lot of upside.
Just on fundamentals, I just see
terrible.
a disconnect that.
That's terrible.
If you're going to have a valuation such as Palantir, I would not argue with the valuation if you were still growing at 50% based on your size, right? Because 21%, you look at the biggest, because they are a software company. If you look at the biggest software company in the world, which is Microsoft, they're growing at the same rate, but Microsoft is massive, right? So they're growing close to what you're growing, but they're 254. They are 100 times bigger than you are, 100. And they're growing somewhere in the neighborhood, same percentage as you. You're not growing that fast. When you're small, it's easy to grow. When you're humongous, it's very hard to grow. So that's my kind of 2 cents is, okay, Palantir is overpriced. And I think
extremely overpriced.
So using Warren Buffett's logic of you shouldn't invest in stuff you don't understand. So I've been in the software business for a while, and I don't claim to know everything about Palantir, but I have worked with enterprise software for 25 years and can understand that, when I'm seeing a company that has true competitive advantage and differentiation, when I look at Palantir, I'm like, okay, they may be the first one to do that, but what they're doing is not unique, and it can be repeatable by Microsoft, Google Alphabet, and others, especially these really strong competitors like Microsoft, Google Alphabet, that if they ever get serious about going after big data, they could pretty much erase Palantir from existence. So that's interesting. We'll see where it goes. A good friend of mine, actually, I saw him yesterday. He's been riding Palantir, and this is his big winner. He every time I see him, he asks me, what should I do with Palantir? And I'm like, I don't know, man. It's your decision. But
tell him
he's
it's going to crash. It's going to come down, but it might double before it comes down. So no matter what, he's not going to be happy, because if it crashes, obviously he's going to be mad. And if he sells now and then it doubles, he's going to be pissed.
I know. So I take the fifth because he's a good friend and I don't want to ruin the friendship. I just go, hey, look, maybe sell some of it, and then you feel like, hey, I'm playing with the house's money. He said, yeah, I already did that. I already recovered all my investment. So what should I do? And I'm like, I don't know. Good luck. Good job picking it. He goes, yeah, but I've got a bunch of other losers. And I'm like, well, maybe you can harvest some losses and match them up with some Palantir sale. Then you don't pay any tax. So I left him with that.
That's good. Good advice. The way I try to think about it, and I say this like to people, if they go, should I buy more of this stock? Should I sell it? I go, well, what would you do right now based on, how much Palantir is trading for, 45. Then just pretend you don't own any Palantir right now. Like, would you buy it right now?
Mm-hmm.
And he'd probably say, no, it's too high. So then maybe sell it. If you think it's too high, you wouldn't buy it, sell it. Because even if you own a ton of Palantir and you said, no, there's no way I'm gonna, because it's trading all time high. Because if you didn't own it and it's at these levels, you'd probably say, I'm gonna wait because I think it's gonna probably come down to like 20, 25. Then I could pick it up. So then sell it, and then when it comes back down to 20, 25, buy it back.
So I think it's a little bit of a funny comment. Anderson, and I believe he tunes in from South Africa. He said he's listening into the audio. He's not seeing our screen. He said without seeing the numbers, he felt the Palantir numbers were unbelievable. The numbers that I was saying, like 248 PE and so forth. They are kind of unbelievable. Yeah. When you have numbers like that, it has to be like, it's like Chat GPT, right? Those guys, they deserve whatever numbers are up there. Like, that's fine when they're not publicly traded. But my point being is those guys are so disruptive right now. They can have a 500 PE and it would still be a stock that a lot of people want to own because that's the disruptor. Those guys are going to break things and take over market share and so forth. But I don't see Palantir as that type of company. They're just a company. They're a software company. Right now, they have a little bit of momentum. It's not even that great. So if they don't announce a good quarter, like some stocks have announced well, like they announced, and I think especially the week before last, some companies, Meta being one of them, I thought had a good earnings, stock went down. Microsoft, I thought had a very good earnings, stock went down. So I think investors either had an expectation that was a little too high and then boom. So maybe the same thing with Palantir. But now that I said it, it's probably going to go up.
I have a feeling it's going to keep going up because it's trend. The trend is your friend. But if history repeats itself, it should come down because you can't go up forever, except if you're NVIDIA, then you go up forever. But if you're not NVIDIA and you're a normal company, you can't go up forever.
Yeah. Interesting. Well, that's what makes stock investing super interesting is, you try to pick the companies that you believe in. And it is really satisfying when you do pick a company you believe in and it does what it was supposed to do. It also hurts when you believe in a company and then they crash and burn. But overall, it's in general, as long as I pick more winners than losers, those losers will be okay. They'll be part of the expense, the cost of doing business, and the winners will reward me. All right. Yeah. So Paycom came up. It was a big winner. I did notice the press release, or I guess the company went up a lot. Let's look at the 5-day. Whoa. That's what I'm talking about. 28%. Beautiful. $11 billion market cap. That looks great. You're paying about 10 times revenue. Let's look at the revenue. But that's it. Why is this revenue just growing 11%? They just went up sky high. Huh. So what is going on here? Why is the stock so hot?
They had good earnings and a good forecast.
I guess
that's the only thing
their guidance is real positive.
guidance.
They've been a consistent free cash flow generator, but again, it's underwhelming, like 11%, and you're a small company. What am I missing?
So up 20% according to Paycom's third quarter. So they beat analyst expectations by 11%, offering improved guidance for 2024. I guess it was just one of those situations where it was everybody was beating down the stock and expecting bad earnings.
That's
and when
it.
they report good earnings.
Look at this chart, right? So this thing's being beat up for 3 years. They're making money and growing. So if anything, it's kind of like, hey, you can't beat it down forever. At some point, it has to come up. And the PE is quite reasonable, 25.4 on the current year, 24.7 future PE. They pay a small dividend. So it's not too bad. Doesn't look like an expensive stock. These guys, what do these guys do? So Paycom.
Payroll.
So HR. Okay. They do it for smaller businesses. Curious
They're
to
like
see what
paychecks, I think.
Yeah. So gross margin's 85%. Wow, that is a nice number. It's a very nice number.
It's a big business.
Their cost of revenue is nothing. Very profitable.
Yeah, it's a good business model. Processing payroll for companies. It's a lot of it is automated. They just have to plug in their employees and how many hours they worked.
Mm-hmm.
And these payroll companies take a small cut. The fees are so small for payroll companies. Like it doesn't even if you could.
They charge per employee. This is a business that I've had personal involvement in.
Yeah.
They'll charge per employee. They might say like, hey, you have 100 employees. We're going to charge you, just to keep it simple, $10 a month. So 100 times 10, you pay me $1,000 to process your payroll each month. And you're right that they have very automated systems. And if they have 1,000 customers, they only have to set up their system once, right? And then they can process payroll for all 1,000 customers.
It's it's almost, because when I started my business, I was doing payroll myself for the first 2 years, but the payroll companies, they were charging like I didn't have that many employees, so it was like $150 a month for payroll.
Per employee?
No, total for the whole month. So I'm like, it was like, it's so cheap. It's like there's no reason not to go with them because I save time, and then there's risk when I do it. What if I don't know the new tax rules or these? But this company is on top of those things. So they just charge so little. I think the way they charge, it's per paycheck. So if you have, usually most companies have 2 paychecks a month. So if you have like 10 employees, so that's 20 paychecks a month. So 20 times like whatever the rate is, 5 or 10 per paycheck.
And what Paycom may be also revealing is, small caps have not done well for the last couple of years compared to the S&P and the NASDAQ. They have been doing better recently, but if you look at the last 2 years, they haven't kept up with the S&P. And Paycom most definitely is a small cap, and it's maybe showing that, hey, some of these small caps are going to start to work because they have good fundamentals. And in the case of Paycom, they have more positive guidance than expected. So maybe small caps might be a place to find some good stocks.
Yeah, you definitely can find good deals. It's definitely riskier. Small caps, they usually don't have as much upside, but if you do a lot of due diligence, you can find a good deal.
Yeah. All right. And maybe we can wrap up with Qualcomm.
Yeah, that reporting earnings.
They've been, to my surprise, they came down recently. You see how they went up. So I owned Qualcomm. I got out of the stock. It went up. I got out. I forgot when, but I got back in. I made money. It dropped. I got back in. And this is still look at their PE. And if you compare these guys to NVIDIA, right? NVIDIA's got a pretty high PE, as well as Broadcom. I owned Broadcom and sold it because it just got really expensive. And I sold it and probably left 40% of appreciation,
I
which
know.
kind of bugs me, but I made money. I didn't get greedy. I made good money. This one here, just the fundamentals look good. 15, 21. I'll show you Broadcom in a sec. And analysts still think there's some upside. So I started building a position of Qualcomm. They're going to announce on the 6th, which is Wednesday. So we'll see what they have to report. One of the things I like about Qualcomm is their chipset is in the Android smartphone, and those things are selling faster than iPhones because they're less expensive. So their Snapdragon chip is in
true. That's true.
those smartphones. If you look at Microsoft announced their AI PC, and it's using the Snapdragon chipset from Qualcomm. So some good things happening for Qualcomm.
Yeah, their semiconductors go into cars, laptops, phones. So they're all over the place, and the demand for semiconductors is so high, and the supply is not nearly as high as demand. So all these semiconductor companies should go up, some more than others.
Here's Broadcom, PE 142.
Crazy.
So I got out of this stock, but made some money. I just got out and it kept going up. Okay. Oh, well. And what's confusing in Broadcom, right? To the naked eye, you go, wow, look at this growth. But this is acquisitive growth. They acquired a company that was, the big growth happened. There's a step up in growth. Yeah, it happened here. So they acquired VMware, which is a software company that enables a company to take a server, let's say, and you can virtualize a server, and it could act like 5 servers or 10 servers. Then you could put workloads on 10 different little servers within one box. So 20 years ago is like, incredible. Like, yeah, that's a very big efficiency gain. So VMware was acquired, and Broadcom wants the software company because VMware charges a subscription. So it's a reoccurring revenue, so very consistent. And it helps Broadcom because Broadcom has a cyclical business in semiconductor. So when you see this growth, I don't consider acquisitive growth as being as great as organic growth. It's just not the same. You paid money for that company. Their balance sheet went up in debt. And yeah, you're bigger, but you kind of did it by acquiring a company. You didn't grow in that space. And they're trying to do something good with VMware. So I think this stock is going to go down in value, in my opinion, because I think it's a little misunderstood, and investors are seeing that growth and buying into the AI hype. And this stock's going to probably disappoint at some point in the future.
Yeah, they all seem overvalued. But how can they keep going up? Some will. It's tough. It's the market's a bit inflated.
Semiconductor as a sector, or as an industry, just nuts how valuable it is now. If you look at technology, I think that's where we're going to see a big correction, I would think. See here, semiconductor. In the 5 years, it's up as a whole industry. It's up 1,458% over 5 years. 1 year, it's up 159%. Incredible.
Unbelievable, yeah.
It's valued at $6.4 billion. That would be 6.4 trillion, excuse me.
Really, yeah.
6.4 trillion. And it left some historically awesome companies like Microsoft's here and consumer electronics. I guess that's like Sony and other companies. So this is what's building out the AI space, and we'll see where that ends up. So,
Yep.
we're 2 years from now, get your crystal ball out. Will AI stocks be worth much more, about the same, or much less?
I don't think it'll be much different. I think it'll be pretty close to where it's at, because I think we bought into the hype and we pushed the stock prices so much higher. Not all companies, like some companies will do better than others, like the Microsofts and Amazons will be better, will be higher in 2 years. But a lot of these other kind of like stocks that just solely rely on AI. I mean,
Yeah,
I know everybody's saying
we'll see. I like the analogy. Well, I don't think it applies, so I won't say it. It was another Warren Buffett analogy, but I think AI right now, just about every company that can say it 100 times during their earnings will say AI, right? So it's a little confusing to see who truly is a transformative company. For sure, NVIDIA is the obvious one. Okay, they own the technology that's patented to have accelerated computing and have GPUs that are best in the business. Okay, done. Then you have some other obvious players like ChatGPT, but they're not publicly traded. Now, the rest of them, there's going to be a sorting out process of who truly is an AI company, who truly is going to deliver a business that is growing, that's generating profits, or will at some point be generating profits. It'd be excusable if a company's like, no, I don't care about profit because I'm expanding the business by $10 billion a year in AI related revenues. So I want to expand as fast as I can so my competitors don't get the market share. So I get it. Okay, that's excusable. So if we're seeing that type of action, okay, great. Those are real AI businesses. But if we're just hearing a year from now, 2 years from now, people repeat the word AI without showing evidence that they have revenues growing due to AI, I think that's where those companies are going to be somewhat revealed, and those stock prices will be lowered.
Yep. And we got to find the winners. That's why we're here.
So Federal Reserve announces on Thursday, we have an election, we have earnings reports, I think, and I'm not exaggerating, like 1,000 companies, because a bunch of small ones are reporting this week. We have all those earnings. And then the Fed's like, hey, let's do a meeting on Thursday. And it's expected they're going to reduce interest rates by 25 basis points.
Yeah.
Which I agree with. I think they're going to do it. Is that your expectation?
Yeah. I think it makes sense. I mean, they did cut 50 basis points last time, which is pretty high because usually they don't go that high in one shot. So it does appear that it's priced in the 25. So yeah,
it's probably going to happen. Okay, good. All right, so let's kind of land the plane here. Any departing thoughts before we conclude?
I'm excited to see how Supermicro responds. So that's what I'm looking forward to. I think the election will things always kind of like get disrupted with the election. I remember cannabis stocks went really high once Biden got elected, and then they settled down, and now they're all down like 95% since the peak. So I just say to stick with the solid companies. Don't try to take too much risk unless you're willing to lose the money.
I'm expecting trading volumes on Tuesday are going to be like incredibly low. Like nobody's trading on Tuesday. They're waiting to see, okay, Is it
Yeah.
going to be team blue or team red? Who's going to win? And there are going to be some industries that rally off of, whether team red wins or team blue wins, right? Like energy stocks. If team red wins, energy stocks are going to be like, oh, they like to drill and remove, you know, uh, you know, regulation so that the oil companies should do well, as an example. And there's other
Yeah.
examples that team blue would benefit. Like you said, cannabis benefited because team blue won the last one.
Yeah. But yeah, it's gonna be a fun week. I'm definitely excited for it. Yeah,
I wouldn't
thanks
mind
for
having a reset or a fast forward button and getting to Wednesday. Boom.
yeah.
Okay, that's done. But we'll have to sit through it.
Okay. Yeah. Okay. Yeah, it was a lot of fun as always. Thanks everybody
Yeah.
for joining and commenting.
Yeah. Thanks everyone for joining. Scott, it's always a pleasure. Thanks again for all you do. Watch your
Thank
videos.
you.
And I appreciate you coming on the live stream. I really enjoyed the conversation and got a lot out of it. Good luck with all your investments. And everybody, good luck with your investments. And thanks for tuning in. I will speak with many of you again soon. Thanks.
Okay. See ya. Bye.